SoFi stock has a strong year-to-date performance of 66%, so is this stock turning a new leaf? Let's get straight into the technicals and the fundamentals to see if it's a buy or sell. In the free Intrendias terminal, there is a buy signal on SoFi. Most recently, as of November 1st, the buy-sell signals algorithm has been lagging the performance of SoFi, bought and held. However, the stock itself from 2021 to today has been a bust, down 38% in the last 3 years. The Intrendias website also provides machine learning price forecasting with the help of linear regression and GARC models, which predicts a bullish move for SoFi with a $9.40 price target within the next 90 days. Also, I have a machine learning XGBoost stock price forecasting model still in the works. However, it has a SoFi prediction of $7 in the next 7 days. In the candlestick chart, I see RSI divergence happen twice for the stock, a bearish divergence in the summer months leading to a 36% slide from $11 a share to $7.20 a share, and then most recently a bullish divergence in October resulting in a 24% run. However, Monday was a rough beginning of the week for SoFi as it is down 6% today, rejecting the trend line in white. The stock is currently testing the 802 support and resistance line. This line was first supported back in March 2022, broke in April, and was resisted 3 times over. The stock broke through this line in June, and the 802 line acted as support twice before the stock slid under 802 in the fall months. On Monday, November 6th, this line seems to act as a resistance, as Monday was a rough day for SoFi, down 6%. A bearish shooting star candle chart pattern appeared on November 3rd prior to this 6% drop. If enough volume came into SoFi stock, we could see another bullish break away from the 802 line, but this does not seem to be the case. In recent news, banks in general had a great run last week because the Fed held interest rates steady for a second straight meeting, potentially signaling that the Fed is done raising rates. Plus, banks had strong earnings last week with greater loan originations and greater interest rates leading to greater revenue. Finally, the softer job report gives credit to the Fed for a potential softer landing. SoFi, although still unprofitable, reported EPS of negative 3 cents, a positive surprise of 65%, with analysts expecting negative 0.9. Moreover, revenue was a 2.9% surprise, coming in at $530 million. SoFi has been experiencing member and product growth up 2.2 million or 47% year over year, and 10.4 million or up 45% year over year respectively. SoFi experienced deposits growing 23%, up 2.9 billion in quarter 3. However, a better metric to look at is the loan to deposits ratio, or LTD. The LTD represents the proportion of bank loans to total deposits. Without deposits, banks cannot lend. Without proper strong deposits, banks are at a risk of liquidity. A healthy LTD is 80 to 90% according to Investopedia. In other words, for every dollar in deposits, the bank extends 80 cents in loans to customers. SoFi has 15.7 billion in deposits, while 20.2 billion in current unpaid loan principals. This results in an LTD of 20 billion over 15.7 billion, or 129%, well above the recommended 80% LTD. Although 129% is far better than the 159.8% experienced in quarter 1 2023, it's still non-desirable. Moving on to member demographics, over 90% of SoFi deposits are from direct deposit members, which means these customers are sticky, as having more money and direct deposit makes it harder to leave a financial institution. The median FICO score was 743, resulting in safer and less likely to default members. Majority of the products are in personal loans at 1 million open products, then student loans at 507,000, and home loans with 28,000 open, all increased from last year September. Student loan originations have increased 101%, 919 million in originations compared to the 457 million, plus student loan repayments have kicked back in, which provides SoFi a re-energized stream of income. Home loans are a new growing sector, jumping 64% for SoFi, and personal loan originations jumping 38%. It's important to note that personal and student loans hold higher risk compared to auto and home loans, as there is no collateral. Currently, based on SoFi's website, a student loan can go for a fixed rate of 4.4% to 14.7%, or a variable rate, which is 6% to about 14%, assuming many of the loan originators are right out of high school going straight into college. I could see much of the loans being on the higher end. If you have SoFi loans, I would love to hear your experience with them down in the comments or in the Intrendias website forum. For the income statement, SoFi experiences a drop in net income in Q3 because of impairment of goodwill as SoFi acquires Fintech mortgage lender Wyndham Capital Mortgage, so this net income drop should be a one-off instance. I'm seeing steady and desirable increase in revenue and exponential increase in net interest income. Regarding cash flow, there's negative 2.6 billion free cash flow, which means SoFi's cash flow from its operating activities is insufficient to cover its capital expenditures and other cash outflows related to its core business operations. In other words, the company is spending more cash than it is able to generate from its day-to-day business activities. And then, of course, the return ratios are below zero. However, we have seen all three ratios increase besides Q3. Price to free cash flow is negative 289. With a negative reading, the ratio will provide us with limited guidance, as such ratios are better off for positive free cash flow companies. However, if we zoom out, we can see SoFi's P over FCF has been increasing even with a declining stock price, showcasing that investors are continuously excited about the fintech. With Q3 earning beat, SoFi is in line to become profitable by Q4 2023, resulting in high expectations for the company's potential to turn its financial situation around, generate positive cash flow in the future, and deliver strong returns for investors. Investors are essentially betting on the company's future prospect. SoFi also received a guidance boost, expecting adjusted revenue of 2.06 billion compared to the previous 2.03. This initial excitement could wane off and lead to SoFi's stock price decreasing in the short term as macroeconomic factors start to settle in. So what are these macroeconomic factors? For September 2023, the total loans and leases in U.S. bank credit was 12.2 trillion, while total deposits was 17.3 trillion. This results in an LTD ratio of 70.5%. Compared to 2008, it was at 95.8%. The overall average banking loan to deposits is much healthier compared to 2008 right now, both values much higher to SoFi's Q3 LTD ratio. However, we will see the LTD ratio increase because of decreasing deposits once peaking at 18.2 trillion in April 2022 after stimulus checks, COVID shutdowns causing less spending, is now down to 17.3 trillion as stimulus checks have stopped, interest rates are rising, increasing cost to borrow, inflation is also rising, and student loan repayments start back up, causing consumer savings to drop even further. This trend could lead us to a high LTV as seen in 2008. Delinquency rates for consumer loans are also on the rise, but not near levels of '08, currently sitting at 2.4%. And let's not forget the inverse yield curve, which has been inverted for more than a year now, starting back in October 2022. Historically, an inverted yield curve has often meant a recession is coming in about a year or so. The inversion has been a decently accurate indicator for recessions. As personal loans, student loans hold greater risk, SoFi could be a risky position if the US undergoes a severe recession. The macro data is not the most desirable. However, SoFi's financials are on the rise, potentially becoming profitable in Q4 2023. To conclude the video, SoFi is in position to become EPS positive next quarter, Q4 2023, which is exciting. However, this excitement from investors could fade out as the macroeconomic data comes into fruition. We're seeing the inverse yield curve. It happened a year ago in October 2022. So we are in the cusp of historically the inverse yield curve coming into fruition and then a recession happening. So that macroeconomic data does not mix currently with SoFi. Another update before the end of the video, we do have SoFi Insider selling. Chad Borton, president of SoFi Bank, and Aaron Webster, chief risk officer, both selling their shares in the beginning of November, 152,000 shares and 215 shares respectively, totaling over $3 million in value. Ultimately, it depends on your risk tolerance, and I would love to hear what your thoughts on SoFi are down below in the comments or the Intrendias website forums. I would love to see you guys there. Check out the website, check out the free Intrendias terminal for buy and sell signals, along with price forecasting using the help of machine learning. Take care, thanks for your time, and I'll catch you guys in the next one.